Good morning, everybody. Hope everybody has had a great week so far. Today we're going to talk about how to replace a policy. There's, all different ways to do it. Before I get started, I just want to go over a couple things that some agents have called me on. On the Get Upside, there's a little form that I've got here that you can go to getupside, I believe, .com, or go to your Google or go to your app store and download this here. It's an opportunity for you to save gas, find participating gas stations. You go there, you gas up. There's some rules you got to follow. Yet you can save yourself, it says, up to 45 cents a gallon. So something I would check into, especially if I was on the road every single day, because a dollar here adds up. Secondly, what Jay's done is that Jay's done a cheat sheet for everybody. We have one for final expense, term, and ULs, and we have one for Medicare, Medicare subs, Medicare Advantage, and the ancillaries of what we have. So you're going to be able to go to the website and print out all the stuff we have. Who has instant approval and e-app? Who does a paperless application? Debit cards, direct monthly billing. So it's something you can go back there. It's on the back office under cheat sheets. It's something that you can look at. Something Heather's going to do a term policy, so she was kind of figuring out which one can she do an e-app on, which one can she do, is there a phone interview? So it kind of runs you down the situation to where if you're not exactly sure, it's going to point you in the direction where you pick the right carrier so you can move forward and make some money. Okay. What ends up happening when we start doing what we do, we've got to learn the carriers, we've got to learn the underwriting, we've got to learn how to make a presentation, we got to learn a lot of different things. So what ends up happening, we want to learn everything at one time, which in my thought process, we should learn a little bit of everything in the beginning. Then what ends up happening, now you're going to learn how to sit and do certain things to fine comb everything. So when you're in a home and you have an opportunity to replace a policy, or an opportunity to at least discuss it, you have somewhat of an idea and some knowledge how to do it. So, let's think about this here. When you're in somebody's home and you're visiting with them, and you get there either on a lead or a referral or a door knock, it doesn't really matter how you get in there, we all have to understand that you have to gain their trust. So when you're speaking with them, they're going to be willing to give you information. And it's kind of challenging to tell somebody, get up and get me your policy. Certain times you have to do it, because if you don't, the policy will not be given to you. So you got to be a little bit politely aggressive. Say, how about getting the policy for me? I like to look at it to make sure it's exactly what you have, what you say. You may not need anything. If you like, I can review it as part of our free service. I'm here to help you. Yet before you start asking these questions, you got to do the little typical warm-up. You guys know how to do a warm-up. What you need to do, you need to find out what policy they have. Hopefully they remember the carrier they have it with. Now, before you talk about replacing a policy, you got to know if they're going to qualify for a new policy. Agents call me and say, Joe, I want to replace the policy. I went over it. They had all this cash value, but then I went and did a phone interview and they got declined. Well, what's happened is that we're getting too aggressive. We're putting the cart before the horse. We're seeing the commission instead of going with the base foundation, to where you got to get all of the information up front before you make the decision to even make that suggestion to somebody. Because what ends up happening, you're going to make a fool out of yourself and you're going to lose the whole deal. You're going to lose everything. Forget referrals, forget anything. Sometimes you got to sit and say, let me just let that go. Let me add something to it. What I'm going to recommend you to do is that when you're visiting with somebody, you need to find out if they have life insurance. If they don't have it, why? If they do have it, how long they had it for? What's the carrier's name? What's the face amount? What's the premium amount? Sometimes they remember, sometimes they don't. That's opportune time to say, you know something, before you go any further, for me to make sure I'm doing my job properly, if you don't mind, please give me your policy. I want to review it so we know exactly what you have, to see what you really need to get. So by going kind of slow with the people, what you're doing is that they're gaining confidence in you, they're getting trust in you. You're not a typical sales guy that's there to sell something. That is why when I go into a house, I carry just leads. I carry no briefcase, no backpack, no iPad, no nothing, because I want them to lower their guard to where they feel comfortable with me, that in the back of their mind, they're not thinking this guy is trying to sell me something. This is why he's doing this here. And the most bizarre part about it is, guys, you have no idea what's going on in their mind. You have no idea who sat with them, who discussed things with them. You have no idea what happened before. So this is why I'm kind of a cautious guy. I want to pack light, go in as if I'm not there to sell anything. Till the time is right, I can just walk to the car. If I feel the client has a possibility of me moving them from one policy to trade that one in, and to trade that one in, get them another one, I want to ask them health questions to see if they qualify. So let's sit and say you're there, the client has not gotten the policy for you, you have no idea about anything. All you know is they've got a $10,000 policy and they're paying $50 a month, and they got it approximately 3 years ago. That's basically all you know. $10,000, $50 a month, they got it 3 years ago, and they've got no idea what the carrier's name is. And you kind of ask them and say, well, let's do it a little bit later. Let me kind of think about it. Tell me what you have. People are sometimes going to sit and be a little resistant, because the mere fact is that, why should I get up and get this for you? Tell me what you got so I don't have to waste my time. Now, you're speaking with them. You've asked them the health questions based on the information you've asked, the information they've given you. You feel they're going to be able to qualify for an immediate benefit program. So you're taking them from a program that's over 2 years old, is past the 2-year contestability. You feel safe that if you move them from old program to your program, hopefully you're going to save them some money, okay? Or get them some better benefits, or they want cash value and they're going to switch it out no matter who comes there. What I recommend you to do is that if you know it's $10,000 for 50, I would go to my little, final expense calculator that we give each one of you guys to have. Go to that little calculator and bring it up, put in their age now, they're 3 years older, put in $10,000 and see what the premiums are. If the premiums come back $10,000 and the premiums are going to be $52 a month, I'm still going to move forward with the replacement, for the mere fact is that they can get a cash value out of that one there. Hopefully the program has a paid up additions in there to where they can get this value. So now they've got a paid up policy and they're going to get another one from you for only $2 a month more. And what you've done is that you've increased their death benefits. Now, not all carriers, but every whole life carrier has a cash value. Cash values grow differently with every company. Depends on usually the higher the premium and the younger the age, the actual cash value is going to grow faster because the cost of insurance is lower. So what ends up happening when you get a client that gets older, the cost of insurance grows, which makes the cash value slow down. Years ago when I got in the business, the policies would endow at age 95 with some companies, normally is age 100. So what happens is the cash value was accumulating quicker because it had a shorter period of time. What the insurance carriers have done now, they've increased it to either 120 or 121. So what they've done, they slowed the cash value process down because they've made the policy last longer to where it will endow at a higher age. So these are things that you're going to learn as you're visiting with people. You're going to learn the different mechanics of a program, of how they really work. So let's say the client gets up, they get the policy for you, and you say, okay, this policy here from Ms. Jones only has a cash value. There's nothing else, okay? Some policies have a cash value, all whole life policies have a cash value. All policies grow at a different rate of speed of the cash value accumulation. Some policies have a paid up portion, which a paid up portion means at a certain period of time, the client can stop making payments and their policy will be considered a paid up policy and they're going to get X amount of dollars. Now, when you look at these on the table and you see 1, 2, 3 the years, and let's say you're at year 3 as the example gave. When you look at the number for year 3, that symbolizes the end of the 3rd year. So if they got it in December and you're now in January, you're in the beginning of the year. So you've got to go another whole 11 months before you get to that 3rd year number. So remember, The number on the left is the years that they've had it. On the right side is going to be a column for cash value, and that number on the left, year 1, 2, 3, etc., the number shown to the right of it will be the end of that year's cash value amount. Next line will say paid up. What that means again is that if a customer says, I cannot afford my policy no more, what options do I have? First option is you can cash it out, get whatever cash value is there, and have no insurance, yet you can put money in their checking account. Number 2, the paid up portion, you can get that amount out, set it to the side, theoretically, and they're going to have what they call as a paid up policy. So in 3 years, the paid up policy may be $700, maybe even $1,000. It just depends again on the company. So let's say, for example, it's $1,000. So they can sit and say, Joe, I kind of want to go with your policy. I want a $1,000 paid up policy because the cash value is only $270. Or if you go to a client's house and the client is ill. Sometimes clients are ill, they've been diagnosed with cancer, something's wrong with them. They do not feel, or you don't feel, they're going to die in the first 2 years. Because the mere fact is, if you sell them a guaranteed issue and they die, sometimes you got to pay all the premium back, half the premium back. If they die, or half or all your commission, depending on the company, if the person dies in the first 6 months, the first year, or the first 2 years. So you need to be careful because you're going to be giving them a policy, but you're going to set yourself up for a chargeback. So you got to kind of go with what your stomach tells you to do at that time. Now, let's say the client was diagnosed with cancer. And the cancer is not what you call something very serious. And the doctor has told the client, listen, we're going to do some treatment on you. You got a 50-50 chance. What you have is something that is we really haven't seen a lot before. We're going to try an experimental drug on you. You got a 50-50 chance. You're going to sit and say, okay, should I leave that policy alone because it's past the contestability, okay, and just see if they want to get some additional insurance and get them a guaranteed issue? That's your first option. The second option is that you can sit and say, you know, Mr. Jones, you got this policy here. It's got a paid up amount to where you can get X amount of dollars paid up and you can get this other policy. But yet that's a little bit scary too, because if their paid up portion is only $1,000 and they've got a $10,000 policy and you roll them to a guaranteed issue, you're not doing the best thing for the client. Could set yourself up for an E&O lawsuit. So you must always do the ethical things for the client, because in my mind, there's no pillow so soft as a clear conscience that when you do something for somebody, you're doing what's best for them and their family, because the purpose of them buying these policies is to give them protection, remove the burden from their children when they pass away. There's also a third column that says extended term. What extended term means is that it is an amount that they do not have to make any more premium payments. They're going to convert that from a whole life into a term product, and it's going to show you how many years and days they have of coverage making no more payments. It does. It's there. I know we've got Royal Neighbors has it, and I know Transamerica has it right off the top of my mind. Has those three options. So when you look at it and the client says, well, the doctor's only giving me a 50-50 chance, and the client wants to do it. Ain't something I'm going to sit and tell you to be pleasantly aggressive to do it if they're not in good health. But let's sit and say it's a little bit longer in the policy. They had the policy for 4 or 5 years, and it tells you they've got 5 years and 232 days worth of coverage on the extended term portion at the face amount of $10,000. And they're telling you, I need more insurance, but I can't afford more insurance. So now you got to sit and think. You got to sit and think, well, what's the possibility of this person living more than the 5 years or the days I stated? Should I do it or should I not do it? So you almost need to have the client say, I'm signing a piece of paper stating that Joe's giving me this option. I agree with it. Thank you very much, to cover your butt in case something comes back. So if the person is ill and they want to move forward, you can convert it to an extended term. You need to call the carrier up to find out, can you do it verbally? Do you have to send a letter in? Can the client do it? Do you have to do it, have them sign it? Does it need a witness? Send it in. Then they can start another policy with you with a 2-year return of premium, guaranteed issue. And if everything works out right, they've got the $10,000 with the 5-year program to where it's got coverage. They get another policy from you, taking those premiums from the original policy, combining it with a couple dollars more to get another policy from you, and you've helped them out only if they die within that 5-year period. If they live longer, they've had coverage, yet it really didn't help them or hurt them, but it's something you need to think about. Let's just say the client's perfect health. Nothing wrong with the client. They've got a carrier that's got some expensive rates. They're our competition. They've got high rates, which the cash value is going to grow a little bit faster. Now you're going to sit and say, okay, what I can do with this person here, since they're in good health, I can give them the option, do you want the cash value or do you want the paid up additions? You're going to get probably 75, 80%, I want my money, and the other 20, 25% is going to say, make it a paid up policy. Whichever one you do, you're not really hurting the client you're not hurting the client really at all because they're in good health and you're giving them something on top of what they already have. Now, clients have the policy for 5 years. Let's say they've got $2,000 in there. The paid up addition on it is $2,500. I'm just pulling numbers out of the air. You got to sit and give them the option of which one they feel is best. What I've done before is that I've done the cash values, I've done the paid up additions, and what we've done is that the person sometimes has borrowed money against their policy. So if a client borrows money against their policy, let's say you got a client that's got a $20,000 policy, and they have now borrowed $5,000 on it, and they've had the policy for, let's say, 11 to 12 years. $20,000 policy, they borrowed $5,000 against it. They really can't afford to make the payments back to the company. So what's happening now is that when a client borrows money, they're still making interest on the money, yet they're being charged a loan fee against that policy. So what's happened, the $5,000 is going to grow to $5,001, $5,004. It's going to continue growing on interest owed to the policy. So now you may sit and say, well, what the client is doing, he's paying X amount of dollars for only a $15,000 policy. What do you mean by that? If a client of yours borrows money from their whole life policy and they were to pass away without paying that loan back, that loan amount and any accrued interest over the months or years that they've had will be deducted from the face amount that will be given to the beneficiary. So you've got a $20,000 policy, they bought $5,000 on it. Theoretically, they're making a premium payment on $15,000. So, depending on their age, it may pay for you to sit and say, well, let me move them to another policy for $15,000, save them some premiums, and then I have to worry about paying that $5,000 back. Again, when you move somebody from an existing policy, especially if it's been over 2 years past the contestability stage, I'm going to caution you to be careful, because what happens is that now they've got a 2-year now contestability period. And I'm telling you this here only for the mere fact is just because you get them approved, certain times clients forget to say something, a medication may not show up, some illness may not show up. Come on in, brother. And what ends up happening is that now the client passes away within the first 2 years, and what ends up happening is that now the policy they had is gone, and the policy that you sold them, all they're going to do is get their premiums back because they forgot to tell you something. So when you're there speaking with somebody, you need to tell them, listen, we're going to make this policy change. I think it's something good. What we need to do, we need to make sure everything about your health is good. So what I like to tell people is that what I want you to visualize, Mr. Jones, is that right now, we are sitting in your doctor's office. It's me and you and your doctor and his nurse there. We're all talking. And you're going to tell the doctor, this is Joe, he's my insurance man. He wants to ask you some questions about my health. And doc, I give you permission to answer anything Joe asks you. You got to draw the picture. You got to make them feel they're inside the doctor's office. And you're going to say, okay, Mr. Jones, right now, you're going to be the doctor because you know all of your information. Tell me about you. Tell me what's happened to you in the last 3 years, the last 4 years. Have you had cancer? What ends up happening is that when you start putting them in that situation, and they visualize themselves sitting with their doctor and the nurse. They're saying, oh, I forgot about something, okay? Unbelievable the amount of people we talk to who have amnesia when you're speaking to them about a life insurance health question. I forgot I had cancer. How in the hell you forget you had cancer? What ends up happening is that they didn't forget. They applied with somebody else, and that person didn't give them immediate benefits. They want immediate benefits because it's lower premiums, and they think they're going to outsmart the insurance carrier, okay? You need to be careful when you're switching somebody. Yet, when you switch somebody, you got to make sure you're moving them from a good situation to a better situation. Whether it be a cash value, paid up portion, or the extended term. I've seen some policies that got 10 more years on them on the extended term. The person said they want the actual cash out because they need the money, they can't afford it. They end up taking the money out and getting another policy. In their mind, they're using that cash value and some of their money to make their premium payments. Wrap it up now. You need to investigate the client that you're speaking with. We talk about, I want you to be a detective, I want you to be a nosy neighbor, I want you to be an attorney, interrogating them to find out everything about them after you've done your warm-up to where they feel comfortable with you and they've got confidence to give you this information. If the person does not feel comfortable with you, you're bouncing around, you're speaking too fast, you're looking out in right field, you're looking out in left field, and you're not giving them what they feel is the proper attention, they sometimes, most of the time, will forget to or just not tell you the truth. And what ends up happening is that you don't know if they're lying to you or not. So you need to kind of ask them the same questions a couple different ways, okay? I like to talk to them about who do you have your health insurance with, how often you go to the doctor, what do your medicines cost? Oh, you have United Healthcare, you have Humana, you have Aetna. Those are my favorite companies. Get them to start to talk to you about their health. The more they start telling you, make notes, forget your memory. Make notes, heart attack 3 years ago, medication. I had a stroke, I had a blood clot. Oh boy, how long ago was a blood clot? Are you on a blood thinner? What's going on? Do you just take a little baby aspirin? What this is going to do by asking these questions here, it's going to make you a better agent. It's going to make them feel that you are doing a better job than the other guy who, when they said they had a stroke, they said, okay. When a client tells me they had a stroke, the first thing I'm going to ask them was, or is, how long ago was it? You doing all right? You feeling good? You back up to maybe 80%, 90%, 100%? Do they have you on a blood thinner? Did they change your medication? Are you on different medication? And what you're doing is that you're asking these questions as a nice person, yet you're gathering information so in your mind you can decide, can the client go with this carrier or can the client go with that carrier? Investigate, take your time. You've got to make sure their health is okay to move them to another policy if you're going to roll them from policy A to policy B. You need to make sure their health is okay. Number 3, before you sit and go through all that stuff there, I'm going to recommend you to go to your little FE cost, look up some different costs based on their new age and what it's going to cost now, kind of start doing some thinking whether it pays to even do it. I rode with an agent years and years ago. I don't know the exact situation. All I know is that the lady was there and she wanted to cancel the policy. She didn't want it no more. She's like, Joe, I cannot afford it. I said, well, I understand you cannot afford it, yet you need to have something when this day comes, because you said the reason you got this policy was so your son would not be left responsible with all of the unpaid debt. So I'm saying to myself, you being a responsible person and having this concern, you just can't cancel and have nothing, okay? I said, do you want to have a traditional funeral or do you want to have a cremation? She says, well, Joe, I thought about it. All I want is a simple cremation. I don't want nothing else. The policy I had before was a big policy for an actual traditional funeral with the visitation and the wake and all that stuff. And she said, I don't want that no more. I don't want it no more. I said, are you sure? She goes, I'm sure. I said, okay. Why don't we talk about this here? What about if you bring that policy out for me? Let me look at it for you. Let me see what options you have. We're going to decide what's best for you there. And what I'm going to do is that I'm going to give you suggestions. You're going to make the final decision on what you want to do because this is your policy. Yet I'm going to tell you, if you want to get rid of that one there, I'm going to recommend you to get a policy to take care of your cremation so we can solve not the first issue, but we can solve both issues. The cancellation and also taking care of your son. She looked at me, she said, Joe, I never thought about it that way. I said, well, I've been doing this for a long time. My job is to make sure that when I come in and visit with somebody, I'm leaving them in a better situation than they were when I got here. So what I want you to do is get the policy from me and let me look at it. I ended up getting the policy. She wanted to cash it out. She didn't want, her health was great, nothing wrong with her. We went from a $10,000 policy, I don't remember how much cash value she had, and she got a little small policy, I think for $2,500. Premiums came down, she put some money in her checking account. I accomplished a traditional funeral, policy with cash value, gave it to her because she had bills to pay. I satisfied her, got her a little cremation policy to where her son wouldn't be left responsible for the unpaid bills with a smaller premium. In years, guys, months, what you're going to do, you're going to start hearing these things, you're going to start listening to people. And what ends up happening, you need to listen to people on what they want and give them solutions. And then from there, since you're there to offer them something, you need to kind of find out what can you do to make them happy and to make you happy to where they get some money and you get some money. So, investigate it, make sure they can qualify for a program, check to see if the price is within there, make sure you got a 2-year contestability that they got to go through. Make sure you, when you're investigating, you ask a lot of health questions, find out everything, put them in the situation if they're sitting with their doctor, with the nurse, tell Joe everything, he's my insurance man, I trust him 100%, I got my total confidence in him. And what you're doing is you're kind of talking about yourself to where they're hearing that you're confident and you've got trust. And believe it or not, that kind of opens people's ears up to where they're willing to open up and talk to you. So with that said, I appreciate your hard work. You got any questions, call the office, get with your managers, hit them hard. Thank you guys, bye-bye.